Let's talk about your tax plan. We've got it in front of us. A lot in it depends on growth, and I was fascinated to hear you just say that you think that if you raise the growth in America from 2 to 3%, that's worth around $2 trillion over 10 years.
It is. It's a staggering amount of money.
What do you see as the biggest risk to that? To that number not happening, to you not being able to get it up to 3%?
Well, I think there are a lot of things that we need to do to create economic growth. The tax plan is one of them, sweeping reform in the tax plan, middle income tax cut, making businesses more competitive. We also need regulatory relief. Too many businesses are held back from making investments because of excess regulation, and we also need fair trade.
Can we just go through some of those? Firstly, on the deductions, you've done a lot about getting rid of most of the deductions. One you've hung on to is mortgage interest tax relief. You look around the world, many people have got rid of that. It plainly distorts a lot of markets, pushes money towards property. Why didn't you choose to target that?
I think the two things we've talked about keeping are charitable deductions, which we think is very important for social causes, and the other is the mortgage interest deduction. And it's a big part of the American dream to own a home.
So it's for political reasons rather than economic ones, per se?
No, it's not necessarily political. Home ownership is important. It's a big part of the economy. Housing finance is a very important part of creating economic growth.
Can we talk a bit about that element about regulations and getting rid of them? Which ones do you particularly want to target? You talked today about Dodd-Frank in some ways being too narrow on finance. You wanted to look much larger. How would you describe that? What is the broader aim, particularly with finance?
Well, in financial services, we're looking at everything. So we're not just looking at Dodd-Frank. We're looking at every single thing that's impacting. And we've had hundreds of people come in. We've reached out to big banks, small banks, finance companies, all different types of areas of the economy that impact credit. And we are determined to make sure we have proper regulation so that we don't put taxpayers at risk, but we also don't have overlapping regulation, and we have clarity so banks and insurance companies know what they can do.
Would you think about a much more sweeping law that dealt with all this? I mean, is it a case of adapting Dodd-Frank or perhaps starting again in some ways?
Well, when we come out with the report, and the first part of it will be in June, there will be certain recommendations that we're making that can be done at the regulatory agencies. There are certain things that can be done by executive order, and there are certain things that will require legislation. But there's a lot we can do without just looking at rewriting legislation, and that's one of the things we're very focused on.